Are you curious to know how you can get pre-approved for a mortgage without hurting your credit score? In this video, I'm going to show you how you can do just that. Hi everyone, welcome to our channel. I'm Megan. Before I get into the juicy tips, if you're new to this channel, it is dedicated to helping home buyers and homeowners, as well as giving tips and tricks to the loan officers and realtors who serve you. So if you haven't subscribed to this channel, make sure you hit that subscribe button and hit the bell to get notified when we release videos that will help you with your credit, personal finances, real estate, and mortgages. So a lot of people think that getting pre-approved is gonna hurt their credit score, but it's not actually the case at all. In fact, there's a few simple things that you can do to make sure that the process goes as smoothly as possible. So let's dig into exactly what you need to do. One of the first questions that a real estate agent will ask you when you reach out, start working together, want to view a home is, do you have a mortgage pre-approval? Many people are hesitant to get that pre-approval for a mortgage because they're afraid of how it might affect their credit score. And this is understandable, as your credit score is an important part of getting approved for a loan. The good news is that getting pre-approved for a mortgage or home doesn't have to hurt your credit score. In fact, it can even save you money in the long run. So let's look at why this is and how you can get pre-approved without it impacting your score. Let's start with what is a mortgage pre-approval. So a mortgage pre-approval is the first step in the home buying process. It's a stamp of approval from the loan officer or lender that you're choosing to work with. And this stamp of approval comes in the form of a mortgage pre-approval letter, which contains the following types of information that gets shared with your real estate agent and then the seller of the home that you want to put an offer in on. It tells them how much you can borrow, an estimate of the interest rate that you'll pay, and the mortgage term. 30-year, how much you're putting down. And it's common for home buyers to confuse a mortgage pre-approval also with a pre-qualification. So let's break down the difference. A pre-qualification is the earliest stage of your research process when you're just looking for general guidance on what are the loan options, what are the payments available to me, and kind of all those what if scenarios and information, but without having credit pulled and knowing really what you qualify for. So once you determine that you do want to search and view homes, it's at that time that a pre-approval is required. And a pre-approval always involves a credit check and review combined with providing other information to the loan officer that's going to help give you guidance and options when you do find the right home. And although not all loan officers will collect documents during the pre-approval process, I highly recommend that you do provide documents at this stage to ensure that there are the least amount of surprises and errors in your qualification down the road. So what happens when you get pre-approved? So when you get pre-approved for a mortgage loan with a mortgage lender or a broker, they typically do a soft pull of your credit report that doesn't affect your overall score, and the soft pull also does not show up on other lenders' reports. So if and when you want to go shopping for loan options and rates, it shouldn't hurt you. The purpose of this inquiry is to simply verify basic information, such as how much debt do you have, what's your monthly payments that shows on your credit report, and really just your overall financial health on your credit. And the lender does that so they can determine the right amount that you qualify for. So if you'd like to see kind of some of what the questions are that are going to be asked during a pre-approval, all you need to do is there is a link in the description. And if you go and click on the link and put your email in, it'll walk you through questions that you can just go through and look at and watch and fill them in. A few of the questions, just so you know what you'll see when you're applying, are: what is your current address? And do you have any other addresses in the past 2 years? Are you currently employed? Who are you employed by? How are you paid? Which is important to break down: hourly, salary, overtime, bonus. Do you receive or pay any child support or alimony? And that's just a sample. Your answers to these questions help the loan officer determine what's called your debt to income ratio by calculating how much monthly income they can use, multiplying that amount of income times the loan product that is good for you, a ratio. And we'll break that down in an example soon. Then they'll subtract all of your combined monthly payments from your credit report with the remaining number of the mortgage payment that you can qualify for. So let's break down a quick example. So let's say that we are doing a mortgage pre-approval calculation and your gross, the total you make monthly, is $10,000. let's say the maximum debt to income ratio that the loan program you qualify for is 45%. So you multiply 10,000 times 45%, which is $4,500. That's our starting point. We have to subtract from that $4,500 all of your monthly payments from your credit report. Let's say your credit report shows a car payment of $600, a credit card for $300 minimum payment, another one for a $400 minimum payment, student loan payments for $700, a co-signed car loan for $300. All of those payments add up to $2,300. So the amount you'd qualify for would be that $4,500 minus the $2,300, which equals a $2,200 payment. This means that you as a borrower need to find a home where the payment totals $2,200 for the principal, interest, taxes, insurance, and mortgage insurance all together. Most loan officers will give you a price range to look at a house within, but I always tell people to keep in mind that the taxes and insurance can vary from home to home. So watching how each possible home's information, the taxes, can change the payment is really smart, because if you just look at the price, you might fall out of the range you qualify for. And a pro tip, it is worth noting that each loan program, you've got conventional, FHA, VA, USDA, non-QM, each one of those sets a different debt to income ratio, with that 45% I use being in the middle range. Therefore, if you're not satisfied with the amount that you've been qualified for, a different lender, especially a mortgage broker, could have more options that help you qualify for more. Now let's go over what are the benefits of getting pre-approved besides knowing what you qualify for. So getting pre-approved before beginning the home search process can save you a lot of time and money in the long run, because it can help you narrow down your search to only properties that you know you can afford. It also allows you to move quickly when you find that dream home, since you've already taken these steps of financing. And this may be really helpful in a competitive market where homes don't stay on the market very long and the seller wants to know you are qualified. Buyers who take this approach may even be able to negotiate better terms due to being ready with proof of funds when submitting offers, which can potentially save you thousands over time, thanks to being able to find that best program and the best interest rate and fees associated with the loan that you're going to decide to go with. But I also think before we finish our video here that we need to talk about how credit scores work. It's really important to understand that your credit score is constantly changing as it reflects information from your credit report, which updates every month. Credit scores can range from 300 to 850, and they're based on 5 core factors: your payment history, your credit balances, length of credit history, types of accounts used, and recent inquiries or new accounts opened. Of these 5 factors, the payment history and the amount owed account for 65% of what makes up your score. That means that if you've been paying your bills on time and keeping your balances low, then your payment history and amounts owed will be good indicators of a really strong credit score. So let's dig in a little deeper into how the credit scores are constantly changing. And this is because scores are more impacted by payment history, mortgage payments being one of them, credit balances, maintaining a strong and active credit history, than a single soft pull or hard inquiry that you do. And that means that a few credit inquiries over the course of 3 or 6 months won't impact your score, even if those inquiries are for mortgages. It's making your payments and keeping your balances low that's going to keep your score up. It's also worth noting what's a good credit score. So one of the most well-known credit terms is what's called the FICO score, and it's created by the Fair Isaac Corporation. And most lenders do use this model to determine a borrower's credit worthiness, where those scores range from that 300 to 850. Generally, a FICO above a 680 is considered good, but it is important to note that although above a 680 is good, someone with a 680 score will not always receive the same interest rate and payment as someone with a 780 credit score. Both Fannie Mae and Freddie Mac, who determine all the loans in the country, and all the lending standards, they follow this tier-based system, and they charge for credit scores. So how the ranges follow, where your score, where your interest rate, or your costs can change, are over 760, you are going to receive the best interest rate, lowest costs. Then the next bracket is 740 to 759, then 700 to 739, a 680 to a 699, a 640, and it just keeps going in these brackets. And each score range listed that I said has the potential, depending on the loan product, to change the rate and the mortgage insurance premium that you're offered. Therefore, the most important thing is to continue to monitor and improve your credit score at all times. So how do you improve your credit score? One of the best ways and the most important steps for anyone is to understand your credit history and score. So more than focusing on not having a credit pull done for pre-approval, if a lower score leads to higher rates, it could lead to financial difficulties and acquire a mortgage. You can work with like a credit counselor or pay down debt or begin monitoring your score through services like Credit Karma or a trusted credit repair company. All of these options can help to lower the cost of borrowing with any new debt, not just a mortgage, and it's going to help improve your ability to get approved for loans going forward. Additionally, learning from your mistakes made in the past also can help prevent future credit mismanagement. It happens to all of us. So take these steps and it will prove to be invaluable during any time you are looking to buy or refinance a home so that you're continuing to strengthen your credit standing in the years to come. We do have an entire blog that you can check out. We'll put a link in the description here, and it does walk you through more ways to improve your credit score if you know that your score is below that 680 range. We also have other related articles that discuss the impact on credit scores of paying credit card debt off or opening new credit lines. All in all, pre-approvals do help you save money. In addition to not hurting your credit score, getting pre-approved for a mortgage loan can also help you save money in the long run, and that's because lenders almost always require some type of credit pull and proof of income when it comes to approving your loan. Therefore, having that pre-approval letter from a reputable mortgage company shows the sellers and agents that you're serious about purchasing. And this gives them, the seller especially, confidence in buyers who already have things lined up, and it may result in your offer being accepted in a bidding war or a lower price being accepted. And another way that getting pre-approved helps you save money, it's by educating yourself on the loan options available to you and the rate shopping between the different lenders that you're looking at. Unless you're working with a mortgage broker who can show you multiple options, but making sure you're doing one of the two. The main point of this video is that there really are not ways to get pre-approved without pulling credit. But we hope that you're learning that pulling your credit is not what's going to hurt your score. But you can ask a lender, a potential lender, are you doing a soft pull or a soft inquiry when they're beginning to do your pre-approval? Because the soft pulls typically involve pulling only some information and not like a full-blown 3-bureau report. So ask the lender you're working with if they do the soft pulls rather than a full pull or a hard inquiry with your data on it. Another important thing about credit inquiries is that the credit bureaus will look at the credit checks you have, and no matter if the check is soft or hard, any credit inquiry from a lender will be viewed as a single check, even if you have 3 or 4 done within a 45 to 60 day window. And so what's more likely to lower your credit score during that same 45 to 60 day window is the other activity and information that has to do with your auto loans, your personal loans, your credit cards on your report, not a couple mortgage credit inquiries. So overall, getting pre-approved for a mortgage loan doesn't have to hurt your credit score. In fact, I hope you've learned that you can even save money doing it, and knowing what kind of loan terms you qualify for prior to searching for a property makes finding and securing your dream home much easier than blindly searching without knowing what kind of budget you're working with beforehand. And understanding how your credit score works and what options are available to help you increase your credit score and not have a negative impact on your credit is just as important. So with just a little bit of research and preparation, watching videos like this, you can make sure that getting pre-approved goes off without a hitch. So I hope that you take advantage of getting pre-approved and learn that it gives you more control with how much money you save and how much you'll spend over the life of a loan. So don't let worries about your credit score stop you from taking advantage of getting a pre-approval, which ultimately will get you your house. And if you'd like to learn more about your credit score or start the pre-approval process, all you need to do is click the link in the description and someone from our team will reach out, schedule a time to talk to you. This is 100% free and there's no payment required. We'll be there to guide you, answer questions, point you in the right direction, I hope this video gave you the insight that you're looking for and that you will join us for more information on next week's video. And if you know someone who could benefit from this information, please share this video with them. Hit that subscribe and bell to get further notifications. Otherwise, continue to check out all our other home buying and home owning tips on our channel and tune in for next week.